Investing. It's one of those words that holds so much promise. We're told it's one of the best tools out there for building real, long-term wealth, for setting ourselves up for the future. But let's be honest, for a lot of us, it can feel like trying to walk through a minefield in the dark, right? It just feels like there are all these hidden traps and pitfalls that can trip up even the smartest people. So today, we're going to turn on the lights, we are going to break down the most common mistakes that investors make, and more importantly, we're going to build a super clear, simple strategy to help you avoid them.
And this is the big question, isn't it? It's the one that keeps people up at night. And honestly, it's what stops a lot of people from even getting started. You see the headlines about someone making a fortune overnight, but then you also hear the horror stories from a friend or a family member who lost a ton of money. You're a smart person. You make good decisions in your career and your life every single day. So why does the stock market feel like this totally different beast? Why does it seem so unforgiving? Well, that's a perfectly normal way to feel. And believe it or not, the answer is actually a lot simpler than you'd think. So here's the secret, the thing you don't really hear on the news. For most people who lose money, it's not about being unlucky. It's not about not having a PhD in economics. It's about falling into a handful of really predictable, and more importantly, totally avoidable traps. Think about that minefield we mentioned. Well, these mistakes are like the big, clearly marked mines on the map. They're all rooted in basic human psychology and some pretty common flawed strategies. And once you see the map, once you know where those traps are, you can start to walk through that field with a whole lot more confidence.
To really get this right, it helps to stop thinking of investing as one giant, scary challenge. Instead, think of it like a battle that you've got to win on 3 different fronts, okay? First, there's the battle inside your own head. That's all about managing your emotions. Then you've got the battle of strategy, using the right game plan and the right tools. And finally, there's the battle of the foundation, making sure your financial house is solid before you even start. You see, you could have the best strategy in the world, but if your emotions are all over the place, you're going to lose. It all has to work together. So here's our game plan for this explainer. This is how we're going to tackle those 3 fronts. First, we're diving into what I think is the most important one, the battle inside your mind. Then we'll get into the nuts and bolts of winning the strategy game. After that, we'll talk about building that solid financial foundation. And to wrap it all up, we'll put everything together into a simple, actionable plan you can start using right away. All right, let's dive into section 1. And I really want this to sink in because it might be the most important lesson in finance, period. The single biggest obstacle standing between you and investing success isn't the market, it isn't the economy, it's you. It's the person looking back in the mirror. Our own brains, the very wiring that helped us survive for thousands of years, can actually be our own worst enemy when it comes to money. And this slide just nails it. The 2 biggest emotions that completely derail investors are fear and greed. Just picture this for a second. The market drops, let's say, 20%. The news is just screaming, crash! Fear completely takes over. Your brain is yelling, get out, sell everything before it goes to 0. So you sell at the bottom, locking in those losses for good. Then, maybe a year later, the market's on fire. Your buddy is bragging about some new hot stock that's gone through the roof. Greed kicks in. That FOMO, the fear of missing out, is real. So you pile in, buying at the top, right before it pulls back. That emotional roller coaster is the exact recipe for buying high and selling low. And this right here, this is the science behind why that fear is just so powerful. It's a real psychological bias called loss aversion. Researchers, Nobel Prize winners, have found that for most of us, the pain of losing, say, $100 feels about twice as strong as the pleasure of gaining $100. Our brains are literally hardwired to avoid losses at all costs. And this makes us do some crazy stuff, like holding on to a terrible investment that's down 50%. Not because we think it's going to recover, but just because selling it means we have to actually admit we lost. So how in the world do you fight your own brain? Well, the trick is to build systems that take emotion out of the driver's seat. First off, you got to have a written investment plan. Think of it like your personal constitution. It lays out your goals and your rules for buying and selling before you're in the middle of a panic. It's your anchor. Second, automate your investments. Seriously, set up that automatic transfer every single month. It makes investing a boring habit, like paying a bill, which is exactly what you want. Third, just tune out the noise. Limit how much you watch the crazy financial news. And last, and this is a big one, do your own homework. Never ever invest in something just because someone gave you a hot tip. Okay, so once you've started to get your mindset right, it's time to focus on that second front, your actual strategy. Because having a calm mind but a terrible plan is still, a recipe for disaster. This is where we move away from psychology and get into the real-world tactics and timeless rules that separate smart investors from gamblers. I know, you've heard this a million times, but it's probably the most important piece of investing advice ever for a reason. Putting all your money into one single stock or one industry is just a massive, unnecessary risk. Think about it. Imagine you put all of your retirement savings into the company you work for. The company seems amazing, unstoppable, but then technology changes, a competitor comes along, and the company goes under. In a flash, you've lost your job and your entire life savings. It's a heartbreaking story, and it happens more than you'd think. And the solution, of course, is what this chart shows: diversification. It's a fancy word that just means spreading your money around. So, on a basic level, that means owning different kinds of things, like stocks and bonds. Why? Well, because they don't always move in the same direction. When stocks are having a bad year, safer government bonds might hold steady or even go up, which helps cushion the blow to your whole portfolio. And it goes deeper than that. It also means owning different kinds of stocks: big companies, small companies, tech, healthcare, and even companies from all around the world. Now, let's talk about one of the most tempting and most dangerous mistakes you can make. It's this belief that you're smarter than everyone else, that you have a crystal ball and you can predict exactly when the market is going to drop so you can sell and then jump back in right at the bottom. It's a total siren song, and it almost never ever works out. The hard truth is, being able to consistently time the market is pretty much impossible. The much more reliable way to build wealth is to focus on your time in the market. The data's crystal clear on this. A huge chunk of the market's best days happen right after the absolute worst days. If you're sitting on the sidelines in cash, waiting for the perfect moment, you're almost guaranteed to miss the rebound. A great tool to help with this is called dollar cost averaging. It sounds fancy, but all it means is you invest the same amount of money on a regular schedule, say $200 every month. When prices are low, your $200 buys more. When prices are high, it buys less. It's an automatic, simple way to buy low over time without having to guess. Hey, let me ask you a question. A tiny little 1% fee. How much damage can that really do? It sounds like nothing, right? Insignificant. But over your lifetime, that 1% fee is a silent portfolio killer. Just look at the math. Let's say you invest $10,000 and earn 7% a year for 40 years. You end up with about $150,000. Not bad. But if you pay a 1% fee every year, your return drops to 6%. After those same 40 years, you'd only have about $103,000. That tiny 1% fee just cost you almost 50 grand. That's nearly a third of your money gone. Keeping your costs low with things like low-fee index funds is one of the easiest ways to guarantee you'll do better. Okay, let's hit our third and final front: building that solid foundation. I mean, you wouldn't build a house on sand, right? So you definitely shouldn't build an investment portfolio on a shaky financial base. These are the steps you absolutely have to take before you put a single dollar into the market. Messing this part up can sink even the best strategy. The number one absolute first rule here is safety. Before you even think about stocks, you need an emergency fund. This is 3 to 6 months of your essential living expenses. We're talking rent, food, bills, just sitting in a boring but safe and easy to access savings account. So why is this so critical? Because life happens. You lose a job, the car dies, a medical bill pops up. If all of your money is in the market and the market happens to be down, you could be forced to sell your investments at the absolute worst time, turning a temporary paper loss into a permanent, devastating real one. Your emergency fund isn't an investment. It's your insurance policy. It's your financial firewall. Okay, now let's talk about the most powerful force in your entire financial life. It's time. You know, they say Albert Einstein called it the eighth wonder of the world. I'm talking about the magic of compound interest. It's that snowball effect where your returns start earning their own returns, and then those returns earn even more returns. And this simple idea leads us to what is probably the single most costly mistake of all: just waiting too long to get started. I mean, just look at this chart. This shows you the unbelievable, almost insane cost of waiting. Check out these numbers. If you start investing just $500 a month at age 25, you end up with over $1 million by retirement. Now, look at the person who waits just 10 years and starts at age 35. They invest the exact same $500 a month. They end up with less than half of that, around $450,000. Just let that sink in. A 10-year delay cost them over $500,000. The takeaway is simple and it is urgent. Start now. I don't care if it's just $20 a month. Just start. The habit and the time are what really matter. All right, so we've covered the three big fronts of the investing battle: mastering your mind, picking a winning strategy, and building that solid foundation. Now, let's pull it all together into a clear, simple game plan you can use as your guide on this whole journey. So here they are, your three keys to success. First, master your own psychology. Know that fear and greed are the enemy. So you create that written plan, and you automate your investments to protect yourself from your own worst impulses. Second, stick to your strategy. Build a diversified portfolio of low-cost funds, and remember that this is a marathon, not a sprint. Wealth is built over decades. And third, build your foundation. Get that emergency fund locked in, and then unleash the power of time by starting as early as you possibly can. That's it. It's really not about finding the next big thing. It's about nailing these three fundamentals.
So we've walked through the whole minefield, right? We've seen where the traps are, and more importantly, we've laid out these simple ways to avoid them. But look, knowledge is just the first step. It's taking action that actually changes your life. So I'm going to leave you with this question to really think about. Based on everything we just talked about, what is the one habit, the one small step you'll commit to starting today? Maybe it's automating that first investment. Maybe it's just opening the account for your emergency fund. Whatever it is, what is that one thing you will do today to start building your future?